I have started three businesses in my life. The first was a courier operation in San Francisco in 1979 that I ran out of a van for 4 years before it became a company with 12 employees. The second was a logistics software firm I co-founded in 1991 that I sold in 2004 for more than I had expected and less than I had hoped. The third was a food and beverage import business in Manila that I launched in 2021 with a woman named Larissa Moreno, who I believed was the best business partner I had ever had. The first two businesses taught me everything I thought I knew about building something from nothing. The third taught me that everything I thought I knew was only useful when applied inside a legal structure I had not bothered to build, and that without that structure, the knowledge was just expensive confidence. My name is Patrick Donovan, 72 years old. I retired from active business in 2018 after selling a small chain of specialty food stores in the Bay Area that I had built over 11 years. The sale left me financially comfortable and professionally restless in approximately equal measure, which is the combination that produces, in entrepreneurial men of a certain age, the specific kind of poor decision-making I'm about to describe. I did not know I was restless in 2018. I thought I was tired and needed a break. By 2020, I understood that what I had called tiredness was actually the exhaustion of a particular chapter, and that the chapter after it had not yet started. I did not know how to start it. The Philippines came into my life through a supply chain relationship. One of my specialty food stores had sourced premium vinegar and preserved goods from a small Filipino producer for several years. And when I sold the stores, the producer's contact, a man named Rodrigo, who handled export relations, sent a congratulatory message and mentioned that the Philippines' specialty food export market was significantly underdeveloped relative to its quality, and that if I was ever looking for a new direction, the opportunity was real. I had always been interested in the country peripherally because of those sourcing relationships, and Rodrigo's message arrived at a moment when I was genuinely open to something new. I flew to Manila in October of 2020 for 3 weeks to look around. Manila surprised me. I had not expected to find the density of food culture that I found, the layered influences, the genuinely extraordinary raw ingredients, the gap between the quality of what was being produced domestically and the international visibility of Philippine food exports. As someone who had spent 11 years in specialty food retail, I could see the commercial opportunity clearly. Not because I was looking for one, I was supposed to be on an exploratory trip, not a prospecting one, but because the kind of gap I was seeing was the kind I had built two businesses around recognizing. I met Larissa Moreno in my second week. Rodrigo introduced us at a trade lunch he had organized for me with several people in the Manila food industry. She was 46 years old, had been working in the food and beverage sector in Manila for 18 years, and had most recently spent 4 years as a senior business manager for a regional distribution company before leaving to go independent as a consultant. She knew the Philippine food market in the specific operational way that comes from years inside it. The regulatory requirements for export certification, the logistics networks, the supplier relationships, the retail entry points in both domestic and international markets. She was direct and quick, and she had a habit of finishing other people's business logic before they got there themselves, which is a quality I have always found both impressive and slightly unnerving in colleagues. I found it impressive in Larissa. We had 3 separate meetings before I flew home and 2 video calls after. By the end of November, I had formed a view that there was a real business opportunity in curating and exporting premium Philippine specialty food products to the U.S. West Coast market, that Larissa had the local knowledge and relationships to execute the supply side, and that I had the retail sector knowledge and the San Francisco market connections to build the demand side. I had also formed a view that Larissa was the right person to build it with, not just competent, genuinely right. She thought about business the way I thought about business, in terms of systems and relationships, and the long-term reputation value of quality consistency. She talked about supplier ethics in a way that showed she had thought about it as a business principle rather than a marketing point. When I raised concerns, she engaged with them rather than dismissing them. All of it was convincing. The conviction was real. I want to be precise about what happened next because the precision is the lesson. In December of 2020, I agreed by email and in conversation to enter a business partnership with Larissa to establish a specialty food export company. We discussed the name, we settled on Pacific Bridge Foods, and we discussed the initial capital structure. I would provide the startup capital, she would provide the local operational expertise and relationships, and we would split equity 50-50. We discussed the types of products we would source, the target retail accounts in Northern California, the timeline for our first export container. All of this was detailed and substantive and reflected a genuine business plan that I had stress-tested in my own head and found viable. What we did not do is have a Philippine attorney draft a partnership agreement. We did not register the business formally in the Philippines under terms that specified my capital contribution, the equity split, the governance structure, or the conditions under which either party could be removed from the arrangement. We did not establish a business bank account with dual signatory requirements. We did not put anything that we had agreed in conversation into a legally binding document. I have started 3 businesses, and I know that these steps are not optional, and I did not take them. And I did not take them because I was 71 years old, and I trusted Larissa, and getting the legal structure right felt like the kind of thing we would get to once the business had started moving, and we had confirmed the relationship worked in practice. That logic, we'll formalize it once we know it works, is the specific logic that cost me $380,000. I have held it up and examined it from every angle I can find, and it does not improve under examination. I transferred $95,000 in January of 2021. This was described as the initial operational capital, supplier deposits to secure the first round of product commitments, warehouse rental for the first 6 months, certification costs for export compliance, and working capital for the first 3 months of operations. Larissa sent me a breakdown of the allocation that was detailed and specific, and the individual line items were consistent with what I knew startup costs in this sector looked like. I accepted the breakdown and did not ask for receipts. The first 6 months were genuinely productive in the surface sense. Larissa sent regular updates, supplier visit reports with photographs, draft agreements with 3 producers, a warehouse lease document, a timeline for the first container. I received samples in San Francisco, actual product, which I had delivered to my apartment and evaluated. The samples were excellent. The vinegars, the preserved fruits, the artisanal condiments were exactly the quality level I had been expecting, based on my sourcing experience. I showed them to 2 former retail contacts in the Bay Area, who both expressed genuine interest in carrying the line when it was available for wholesale. Everything was moving. The business felt real because the product was real, and the conversations with buyers were real, and Larissa's updates were thorough and responsive. In July, she raised the first expansion request. A 4th producer, a small family operation in Batangas that made a preserved fruit line she described as potentially the best single product in the portfolio, had an opportunity to scale their production and commit exclusively to Pacific Bridge Foods if we could provide an advance payment against the first 3 container orders. The amount was $150,000. She said this kind of commitment was how you locked in quality suppliers before competitors identified them. That the exclusivity was the value, and that without it we would likely be competing for the product within 12 months. That logic was sound. I had made similar arguments to investors in my earlier businesses. I transferred $150,000 in August. My friend and former business partner Raymond called me in October. We had co-founded the logistics software firm together, and he has been one of the people I trust most on business judgment for 30 years. I told him about Pacific Bridge Foods and about Larissa and about the transfers. He asked 3 questions in sequence. First, what does the partnership agreement say about use of capital? I told him we had not finalized the formal agreement yet. He said, Patrick, just my name, in the tone that means he is collecting himself before saying something he knows I am not going to enjoy hearing. Second, who are the signatories on the business account? I told him Larissa was managing the operational account for efficiency. He said, so she controls the money. Third, have you seen audited accounts for any of the spending to date? I said I had seen Larissa's reports. He said, Patrick, those are her reports about her own spending of your money. That's not an audit. That's a summary. He said I needed to engage a Philippine accountant to conduct an independent review of all expenditures to date, and I needed to do it before I transferred another dollar. He said, I know you trust her. I'm not saying you're wrong to trust her. I'm saying trust doesn't replace structure, and you of all people know that. I told him I would sort the structure out in the next month. I had said the same thing for 10 months. The independent accounting review did not happen in November. It did not happen in December. In January of 2022, Larissa presented what she described as the major opportunity the business had been building toward: a chance to acquire a controlling interest in one of our core suppliers, a producer whose owner was looking to retire and had offered Pacific Bridge Foods right of first refusal before going to market. She said the acquisition would vertically integrate our most profitable product line, dramatically improve our margins, and create an asset that could be sold independently if we ever wanted to exit the business at a premium. The acquisition cost was $220,000. She said the window was 60 days and that the owner had one other interested buyer. I sent the acquisition summary to Raymond. He read it and called me and said, with a patience that I recognized as the patience of a man who has said something important once and is preparing to say it in stronger language, Patrick, I need you to hear me. Do not transfer this money without an independent attorney reviewing the acquisition structure and without me or someone I trust looking at the financials of that supplier company. If this opportunity is real, it will survive 3 weeks of due diligence. If it won't survive 3 weeks, it isn't what it's presented as. I told him the 60-day window gave us time. He said, then use it, please. I told him I would arrange the due diligence. I transferred the $220,000 2 weeks later without arranging it, because Larissa had told me the competing buyer was moving faster and that waiting risked losing the opportunity. I knew when I pressed send on that transfer that I was doing something Raymond had specifically told me not to do. I knew it, and I did it anyway, which is a thing I cannot explain except to say that the momentum of a business you have been building for a year is a powerful force, and stopping it, even briefly, feels like a kind of failure that an entrepreneurial man does not want to experience. The total at that point was $465,000. I note the discrepancy between this number and the title of this story. The title says $380,000. The $380,000 represents what I have been able to establish was definitively misappropriated based on the subsequent investigation. The remaining $85,000 of the $465,000 total may have been spent on legitimate operational costs in the early months. I say may because I could not fully verify it. What I can say with certainty is that $380,000 went somewhere other than where it was said to go. The change I noticed first was in Larissa's responsiveness. Through the early months of the partnership, she had replied to messages within hours. In March of 2022, the replies started coming a day later, then 2 days, then with the particular brevity of someone who is managing a conversation rather than participating in it. I asked for the acquisition completion documents, the signed agreements that should have been produced when the supplier purchase closed in February. She said they were being finalized by the attorney. I asked for the attorney's name and contact so I could follow up directly. She gave me a name and a phone number. The number rang through to a voicemail I left messages on twice and then received no callback from. I asked for a full financial accounting of all capital deployed since January of 2021. She sent a spreadsheet. It was formatted like a financial report and showed numbers that, when I added them up, accounted for approximately $390,000 of the $465,000 I had transferred. The remaining $75,000 was described in a line item as operational reserves. I asked for bank statements supporting the spreadsheet. She said the statements were with the accountant who was preparing the year-end documents. I asked for the accountant's contact. She gave me a name. I searched the name against the Philippine Institute of Certified Public Accountants Registry and found no matching record. I flew to Manila in April, not announcing the visit in advance, not a deliberate strategy. I simply booked and flew without telling Larissa until I landed. She met me the day after I arrived, which was the first sign of difficulty since I had always been able to see her the same day when I was in Manila. We met at a cafe rather than the office, which I noted. I asked her directly, where is the $380,000 that is not accounted for by verifiable receipts? She said the business had faced unexpected costs that had been absorbed in ways that were difficult to document in the short term, but would be reconciled in the annual accounts. I asked when the annual accounts would be prepared. She said the accountant was targeting June. I asked for the accountant's full name and firm. She gave me a different name from the one she had given me before. I wrote it down and said nothing. I spent the following 3 days in Manila with an independent accountant named Fernanda, found through the American Chamber of Commerce Philippines business directory, and a Philippine commercial attorney named Jose, found through a referral from the U.S. Embassy's business services list. I had brought every document Larissa had ever sent me, every update, every spreadsheet, every supplier agreement, the acquisition summary, the warehouse lease. Fernanda and Jose went through all of it over 2 days. Their findings, delivered to me in a meeting at Jose's office, were the clearest and most uncomfortable 2 hours of my professional life. The warehouse lease was real. The warehouse existed and had been rented, though the lease had not been renewed after the first 6 months. The certification costs were real. The export compliance work had been done, though it had been completed at a cost substantially lower than what had been allocated in Larissa's original breakdown. 2 of the 3 supplier agreements were real, both for small amounts and both showing evidence of actual product sourcing. The 3rd supplier agreement for the highest value product line showed a signed contract but no evidence of any payment being made to the supplier, who Fernanda contacted directly and who confirmed he had received only a small deposit and had not heard from Pacific Bridge Foods in 6 months. The Batangas exclusivity payment, the $150,000 acquisition advance, Fernanda found no evidence of it reaching any supplier. The supplier I had been told was the target of the exclusive commitment had no record of any payment from Pacific Bridge Foods or from any entity associated with Larissa Moreno. The acquisition of the producer's business, the $220,000 transaction, had no completion documents because it had not closed. The seller, whom Jose contacted through the legal registry, confirmed an early conversation with Larissa, but said negotiations had ended when she stopped responding to his attorney's communications in January, before I had transferred the money to fund the purchase. Jose's summary was precise. The business had been used as a framework within which real operational activity occurred in the early months, enough to produce genuine product samples, real supplier relationships at small scale, and credible progress reports, while the majority of the capital had been diverted through the business account to destinations he could not trace without a formal legal process. He said the absence of a formal partnership agreement and the single signatory account structure meant I had no contractual claim that was immediately actionable and no account control mechanism that could freeze remaining funds. He said, "Mr. Donovan, I want to be honest with you. You funded a business without the legal structures that would have protected your investment, and the person who benefited from the absence of those structures is the person who suggested operating without them." He said it without judgment, which made it easier to hear and no easier to absorb. I called Raymond from Jose's office, which was perhaps not the usual place to make a personal call, but felt necessary. He answered and I told him what Jose had found. He was quiet for the length of time it takes a man to process something he had warned his friend about and did not want to say he had warned his friend about. Then he said, "What do you need from me right now?" I said I did not know yet. He said, "All right, I'm here when you do." That was the right answer. I appreciated it. Larissa and I had one final meeting, 4 days after Jose's review. She arrived at the same cafe with the composed manner of a person who has decided how to conduct a difficult conversation and is executing that decision. I told her what my attorney and accountant had found. She did not deny most of it. She said the business had experienced serious cash flow problems in the second half of 2021 that she had managed by using capital from later transfers to cover earlier obligations, which had created a gap between what the books showed and what had actually been deployed operationally. She said she had intended to close that gap with revenue from the first export container, which had not materialized on the timeline she had projected. She said, "I did not set out to take your money, Patrick. I set out to build a business, and the business failed, and the way it failed created a situation I did not know how to tell you about." I asked her about the $220,000 acquisition transfer. She looked at her hands. I said, "The seller says the deal was dead before I sent that money." She said, "I thought there was still a possibility of reviving it." I said, "That is not the same as it being alive when I sent you $220,000 to close it." She did not respond to that. The cafe was quiet for a while. Then I said I would be proceeding with the legal complaint, and she said she understood, and we left, and I have not spoken to her since. Jose filed a criminal complaint for Estafa and a civil claim based on the wire transfer records and the evidence of misrepresentation in the acquisition transaction. The civil claim has the strongest basis because the $220,000 transfer was made on the specific and demonstrably false representation that a transaction was imminent. The criminal complaint is being investigated. Neither process moves quickly, and Jose has been honest with me about that. Raymond, who has seen more business litigation than most people, said when I told him about the legal strategy, "Patrick, you'll probably recover something. Enough to feel like partial justice, not enough to feel like full justice. That's how these things usually go." I accepted that. It is probably accurate. I have been back in San Francisco for 7 months. The city is the same, and I am different in the specific way that a person is different after an expensive education. Not broken, not embittered, but recalibrated. The entrepreneurial restlessness that took me to Manila is still present. I have not solved it by losing $380,000. What I have solved permanently and irreversibly is my willingness to operate a business without the legal structure that is not optional. Not for reasons of distrust, for reasons of sense. Raymond built 2 businesses with me, and I built the agreements before I built anything else. Every time without exception. And the one time I skipped that step was the one time the step turned out to be the whole floor. What I understand now about Larissa, who I believe was a competent business person who made decisions she could not find a way back from, rather than a purely predatory operator, is that the legal structure protects both parties. It protects the capital investor from misappropriation. It protects the operational partner from the temptation that unstructured access to someone else's money creates. The absence of governance does not just make fraud easier, it makes failure messier and more total than it needed to be. If we had had a dual signatory account, every payment would have required my co-approval. I would have known in real time where every dollar went. The moment a proposed payment did not match a verifiable supplier invoice, I would have withheld approval, and we would have had a conversation that might have surfaced the cash flow problems while there was still something to salvage. The legal structure is not just protection against bad faith. It is the framework that makes good faith navigable when things go wrong. Raymond says I should write a guide for retired entrepreneurs considering foreign market ventures. He says what happened to me is preventable at the structural level and that the people who need to know that are not reading law journals. He might be right. This account is not that guide, but it contains the essential point of it. The relationship is not the business. The relationship is what you hope the business will be built on. The business requires its own structure, independent of the relationship, enforced by documentation and account controls and legal agreements that do not depend on trust to function. Trust is personal and valuable and frequently warranted. It is also insufficient. The two things are not in conflict. You can trust a person and structure the arrangement correctly. You can like a partner and still require dual signatures. You can believe in someone's intentions and still get your own attorney. The structure is not a statement about the relationship. It is what makes the relationship survivable if things go wrong. And things go wrong in business, always. In every venture I have ever been part of, things have gone wrong. The question is never whether they will go wrong. The question is whether the structure is strong enough to contain the going wrong and keep it from becoming this. I am still in contact with Rodrigo, who introduced me to the Manila food industry and who was genuinely mortified when he learned what had happened. He has not lost faith in the opportunity he identified, and honestly, neither have I. The Philippines' specialty food market is what I thought it was in 2020. The product quality is real. The export gap is real. The commercial opportunity has not changed because one business partnership failed badly. What has changed is that if I ever go back to it, and I have not ruled that out, which surprises people when I say it, I will begin with the legal agreements and the governance structure and the independently controlled accounts. And the business will grow out of those foundations rather than trying to add them to something already in motion. That is how I built the first two businesses. I knew that. I set it aside. I will not set it aside again. $380,000 is a significant amount of money. It is not everything I have, which I know makes me fortunate in ways that some people in similar situations are not. It is the cost of a lesson I should not have needed at 72, having learned its substance decades earlier. But lessons you already know are only useful if you apply them. And I did not apply this one. And the reason I did not apply it is the same reason people do not apply things they already know. I did not think I needed to. I was past the stage of needing to build every foundation from scratch. I was experienced. I could see the opportunity clearly. I trusted the person. Experience, clarity, and trust are genuine assets in business. They are not substitutes for structure. They never were. I knew that. Now I know it differently in the way that knowing and having lived it through are different things, and the difference cost me $380,000. That is the whole of it.